Signet Jewelers reported its fiscal third quarter results last Thursday, and the picture was mostly negative. Sales for the 3 months ending November the 2nd declined 3% year-on-year, while net profit fell 40%. Signet is, as you might know, the US's biggest diamond retailer, owning Kay Jewelers, Jared, Zales, and more. You can see our full write-up at this link. Let me tell you the reason why this week's video might be longer than usual. Signet provides its quarterly earnings in a few waves. At about 7 a.m. New York time on results day, it sends out the press release with the key information on revenue, profit, and average transaction value, with a bit of commentary that tends to present the results in as positive a light as possible. Here at Rapaport, our first job is to work out quickly what the story is and whether the results are good news or bad news for the industry. A guide we use for this is the pre-market trading in the company's shares before the New York Stock Exchange opens. At about 8:30 a.m., Signet's management holds an investor call discussing the results and how it views the market and answering stock analysts' questions. At around 9 a.m, it releases its 10Q, the full quarterly report, which also provides a breakdown of sales by banner and category, as well as some dispassionate and useful commentary on why sales and profit performed as they did. Finally, at 9:30 a.m, the markets open for real, and that gives us a clearer picture of how investors view the results. All these different stages help us to get the big picture on the meaning of the results for the industry. But before I tell you what happened this year with Signet, please make sure you are subscribed to our channel and like, comment, or share this video so that we can keep bringing all the updates and insights about our industry every week. You're also invited to leave us comments and let us know your predictions for the next month in your business or in the industry in general. So going back to last Thursday, Signet's share price fell 12% during the day in the wake of the results, reflecting the sales decline, some cautious commentary the company gave about jewelry demand, as well as a cut to the company's earnings forecast. One of the reasons was Signet's Blue Nile and James Allen digital banners, which suffered technical problems that limited transactions. On top of that, Signet also added the effects of hurricanes in the southern US, a slower than expected recovery in engagements, uncertainty in consumer spending patterns, store closures, competitive price pressure, and the sale of its prestige watch business in the UK. Let's zoom in on some of those factors. We have spoken before about Signet's prediction that engagements would rebound in 2024 as a delayed reaction from COVID and the post-pandemic boom in dating. This turns out to have been a little over-optimistic. The bridal segment was the weakest part of the business in the third quarter, with sales falling 5% year-on-year. Since bridal is by far Signet's biggest category, this decline had a big impact on the overall top line. In the 10Q filing that we mentioned before, we can see that out of a total decline of $42.5 million in sales year-on-year for the entire company, $33.3 million of this was because of bridal. Sales of fashion jewelry rose 1%, more on that later. The other factor we mentioned was the problem at the digital banners. Joan Hilson, Signet's Chief Financial and Operations Officer, gave some more detail on this in the investor call. She said there was a delay to re-platforming of its James Allen and Blue Nile website, which impacted traffic, especially in the second half of the quarter, so around October. This has seen some improvement in the current fourth fiscal quarter. But there are also other factors regarding competitive pricing. This is a theme that comes up a lot in Signet's reports. Other companies undercut Signet, and I'm going to guess that this is mostly the large retail chains and department stores, though Signet didn't say this. In this area, Signet suffered in bridal much more than it did in fashion jewelry. The best metric for this is average transaction value, or ATV, which indicates the type of jewelry people bought, as well as the pricing. In the third quarter, Signet's overall ATV in North America was flat year-on-year at $622. The ATV for the bridal segment in North America was down in the mid-single digits because of, to quote Hilson, competitive price pressure in loose stones. She didn't specify whether this was natural diamonds, lab-grown, or both. However, we know that the North America ATV for fashion jewelry rose in the mid-single digits, driven by 30% growth in sales of pieces featuring lab-grown diamonds. Signet also found that fashion products that were new to Signet's assortment commanded a strong premium. This brings us to the key strategic point that Signet brought up. The company is using lab-grown fashion jewelry to get through the choppier than expected engagement ring environment. And fashion jewelry with lab-grown diamonds carries twice the ATV of fashion jewellery without lab-grown diamonds, Signet said. According to Hilson, this boost to transaction value is also beneficial at a time of falling lab-grown diamond prices, which have dropped faster at wholesale than at retail. She also said Signet was providing more branded bridal products to deal with this. What we do understand as the key message from Signet is that it's betting on lab-grown fashion jewellery, seeing this as the category with the most potential value. This might not be what the natural diamond industry wants to hear, but it's probably better than hearing that synthetics are taking over bridal. What might happen when and if engagements finally recover is another question. This video is brought to you by Rapnet, the world's largest and most trusted diamond trading network. If you buy and sell diamonds, Rapnet is the right solution for you. Find out more at rapnet.com. Thanks for watching and enjoy the rest of the week.